to this beautiful Southwest region. So welcome. Here's a customary acknowledge to country slide. We're very lucky to be able to use this land that our traditional owners have been part of for many, many, many generations. So we're very lucky to have this opportunity. So welcome to Southwest Connect. It's interesting, you know, like last year we had the inaugural event, and it's good to see so many familiar faces here. And during that period of time of October 2021, organising conferences seemed a bit of a challenge. We had the dreaded COVID hanging over. There were issues like, is this city in a lockdown? What are the rules in relation to social distancing? How many people can be in a square meterage area? And we thought, you know, it's now May 2022 and we don't need to worry about all those rules. And as each month passed, all the governments started to relax their rules. And so from the outside, you thought, gee, organising conferences would be pretty easy, much easier. Well, then there were new words that started to present themselves. Inflation, fuel prices, airline prices. We watched the Dow Jones go from 37,000 points to 27,000 points. And there were new challenges for organising conferences and in particular investment conferences. And the point that I'm getting to is I just really want to acknowledge everyone that's here for making the effort, for being here, supporting vertical events, this conference. And that goes from the 60 odd companies, ASX listed companies who have signed up to present, to all our sponsors, and we'll go through them shortly, to the many investors, whether they're retirees or part of family offices or from stockbroking firms. Vertical Events really appreciates your support, both through the COVID period and now through this period. But one of the most exciting things that we're embarking on is the drive towards the EV sector. And we're going to hear a lot of presentations in relation to that. And we're going to also hear a lot of presentations in regards to a whole diverse range of companies that are listed on the ASX. That's another component to Southwest Connect that we're really pleased about. We've got biotech companies, we've got tech companies, we've got municipal cannabis companies. We've got it all covered today for you over the next 3 days. So make sure you sit back and enjoy the experience. Take the time to go down to the exhibition tables, have a chat to the people that are representing those companies. They'd really appreciate your interest and support. And you never know, there might be some great investment opportunities that you can pick up on over the next 3 days. But as I said, these conferences don't exist unless you've got some really great sponsors. And I want to kick off by announcing our major sponsor, Canaccord. We're really lucky to have such a great partner. As some of you may be aware, Canaccord has an office in Busselton. So that works well from driving this conference to their local clients that are based here. But I just want to acknowledge Chris, Webster, and also Jade and Emma and David. They've from the Perth office, they've been tremendous with making sure that they've got so many things organised when it comes to their function tomorrow night and encouraging a lot of their brokers and private wealth people to get down and support the event. So thanks a lot to Canaccord for that. Pleased to welcome the ASX over all the way from Sydney. So it's great for them to be supporting this. We've got Ajita and Giri and also James Rowe. And the ASX will be giving a presentation later today in this auditorium. And they're also sponsoring a COSEC seminar, which we're holding on Thursday. And that's designed for directors and company secretaries and executive assistants to get down to a room which is down near the cafe on Thursday and have a chat about all company secretary things. And then we've got Automic Group. Those of you who invest a lot, you'd get a lot of correspondence from the Automic Group. They're the share registry services for a lot of the companies that are participating. So it's great to have Ben Kay and his team here supporting. BDO, I can see Adam Myers up the back. Great accounting firm, very supportive of vertical events. So thanks Adam and his team at BDO. Jackie is here from Gallagher's. They're bringing their team down. They're also part of the COSEC function, so they'll be giving a bit of presentation. So for any insurance matters, make sure you touch base with Jackie and Gallagher's. The Lynn Partners, a New York-based fund, very supportive of vertical events. Next up, we've got Steinapag. It's great to have Toby Hicks and his team here supporting us. They're one of the big players when it comes to assisting junior mid-cap companies with their legal requirements, and they've been exceptionally busy during the IPO boom of 2021. It's great to have, I'm sure some of you have had a coffee this morning, so thanks to McKay Drilling for providing the barista coffee. And then we've got another drilling company, DDH1. They'll be, who'd be surprised that a drilling company is putting on some drinks at the end of the day. So it's good to have them supporting us here. And then all our media partners. So we've got a lot of sponsors, we've got a lot of companies presenting, and we've got a lot of people coming through over the next 3 days. So all we just want you to do is just enjoy yourselves, ask questions, get involved, interact, engage, and looking forward to a busy 3 days. And now I'll pass you on to Chrissy Morrissey, who's going to MC the next 3 days.
Thank you so much, Jax. I am Madam Lash. It's lovely to have you all here. What a fantastic little arrangement we have with one another for the next 3 days. And we have got the best weather. Before I forget, there's one thing I wanted to point out to everyone that we don't have that we didn't have last year that we do have this year, and that is a marquee outside with a second barista and tables. So we want to make sure you really make the most of your trip down here. If you've come from anywhere else, you've come from Sydney or anywhere else in Australia, we want to show you what our beautiful Southwest is all about. You saw some of those fabulous pictures that our team put together in the opening. That surfer was actually Jed at the back. Stick your hand up, Jed. You up there? Where'd you end up? Where's Jed ended up? He's too busy working outside, is he? So the surfer was actually Jed, one of our vertical events team, who took it on the chin, took one for the team. He came down with his surfboard and he shot all those shots for us for the start this morning. So we want to show you what this area is about if you've come from somewhere else. So please grab a coffee or a cup of tea, go out there and chat investment potential. I'm going to keep my part here very brief this morning, and I'll tell you things that are going on as we go throughout the day. Essentially, I'm going to sit up when there is 2 minutes to go. I'm going to ring my bell at 2 minutes. I'm going to stand up if you're a speaker at 1 minute. And with about 10 seconds to go, if I'm close to you, very, very close, you need to move very, very quickly because I've got quite a good right hook. Okay, so we need to keep things running in time. So that's why I say I'm Madam Lash in the nicest possible way. It's my job to keep things moving and going, but also to ensure that you have a fantastic experience here. So let's kick this off, shall we? Jaxon mentioned our major sponsor. We are so glad to have Canaccord back. And their CEO was so desperate to come back here. He's based in Melbourne, and he was like, I really want to come here, didn't he? And he said, look, there's so much to see. We've got 60 investors to analyse. You've got this great weather. You've got fantastic Southwest food, wine, beer. I'm going to book a ticket. He's in Melbourne. Guess what? There was a small problem. So instead, Christopher Webster is going to open officially our conference for 2022. Please make him welcome, and he will explain a little bit more. Christopher.
Thanks, Chrissy. Yeah, so popular is this region becoming that all the flights from Melbourne are completely booked out. So we did have a contingent in Melbourne, and they're sadly stuck to the live stream because they couldn't actually get here. So it's a great sign for the region. And before I get onto the region, I just want to thank Stu and Jaxon and Andrew and Prue and that vertical events team. If you want to know what resilience looks like, running conferences through COVID, what a team to endure that. And we are certainly very appreciative that they have allowed us to be part of this conference. Like the Busselton region, we think this conference will go from strength to strength. This is one of the fastest growing regions in Australia. We're very proud to have had an office here for over 20 years, and our team here is growing. So we've now got 7 full-time staff around the corner. They will be at the booth during this conference, and please step by and say hi to them while you're there. And if you're coming to our cocktail party, then head to the booth as well. We'll give you your registration band so you can get there safely on the buses and those kind of things. So, listen, what's special about Canaccord in this region? Well, listen, we're a global investment bank headquartered in Toronto, and we have a presence in Busselton. And the network of Canaccord is quite phenomenal. The global research that filters down through our offices is real. Very delighted to introduce Tony Brennan to you this morning. So Tony's based in Sydney. He's our Chief Investment Strategist. Every morning at 6 o'clock West time, he briefs the dealing team of 112 advisors, and his job is to decipher what's happening out there in the global markets, deciphering the geopolitical, what's happening in the US, what's happening in Europe, the war in Ukraine, and he frames it to us in a way that we can understand what it is, and then use that to determine how we're going to position our clients' portfolios for risk, and ultimately what goes into those portfolios. We really want to educate our clients, help them navigate markets, but also provide opportunities. And I think over the next couple of days, you're going to hear from 50 companies that present great opportunities. But, you know, sadly and heartbreakingly, there's another 50 that wanted to get on the card as well, but we couldn't quite fit them in. So really delighted to be here. Canaccord's very proud to be associated with this. And I hope you have a wonderful few days, and please come and say hi to us when you get the chance. Cheers. Thanks, Chris.
I think I'm on, yes. Good morning, everyone. It's a pleasure to be here, coming from Sydney. A beautiful day here, which we haven't had that many of this year in Sydney, the past 12 months. I think my role here today is just to give you a bit of background on the global economy and the markets, you know, going into 2023. You know, because you'll be hearing from a lot of resource companies. They'll give you some background to, you know, consider those companies. And I'm mindful of Madam Lash. I don't want to incur her wrath, so I want to make sure I stick to schedule. So in my presentation, I'll probably flick through some of the material. It's a bit longer than we need, really. So I don't think you'll probably, you know, you probably have a fairly reasonable understanding that the global economy is getting a bit tougher, and probably next year will be a weaker year for growth for the world. We've got sort of a slower picture in all the big economies, the United States, Europe and China. Not much to differentiate them, although they have different issues. And we'll have a slower path here as well. How bad it is remains to be seen. I think there's some hope that it's not too dire, which I'll sort of try to illuminate for you this morning. The markets have been tough in advance of that, as Jaxon mentioned, and there's reasonable grounds for thinking they'll be better next year. And you know, there's still a lot of uncertainty, and I think at the moment anxiety is probably the highest we've had through this whole year, to be honest. And it's because I think a lot of investors and economists and analysts and governments, politicians, think we're not really making much progress in getting on top of the issues. And so what I wanted to talk about today is the progress we are making, because that's the title of the presentation I'm bringing. And I feel we are potentially at a bit of a phase now where the outlook starts to get a bit better. And so in terms of our advice, our investment advice, having been very cautious since early in the year, so recommending investors hold a lot of cash without much exposure to any real asset class, we've just recently gone to a bit more of a neutral position, trying to get people to come back into markets a bit more. We did that with regard to fixed income investments in around June, and we started to do that with equities this month. We're not necessarily telling people to go overweight into those investments, but just maybe coming back to neutral, because I think the outlook is a bit more two-way now. I think it was very much one way to the downside early in the year, but I think it's become a bit more two-way. Things can go wrong still, there's no question. It could get worse for a bit, could be choppy for a while, but it does make, you know, we've still got a couple of months this year. We could go into next year with a better outlook for markets, even if the global economy is a bit weak. Things can go wrong, but things can also go right. So that's the focus. I'll quickly flick through and just take my phone out to keep an eye on the time, because I don't want to get wheeled off. So let's get started quickly. So look, I think it might have been a surprise to everyone this year that it has been this difficult in markets, because we've had some pretty tough years in the prior to a pandemic, for goodness sake. And everyone was hoping probably it was going to be a little bit more back to normal, but getting back to normal hasn't been so straightforward. And so this year has been about some new challenge, which I've just tried to summarize here. It won't be anything surprising to you if you follow the news. None of this is going to be too much of a shock. But, you know, the pandemic itself was a pretty dramatic event, and getting out of it required a lot of policy stimulus, which is now probably overcooked things a bit much. So that's had to be reined in. And we've still got this sort of legacy of some of the constraints of the pandemic. So people's spending patterns, the supply of goods and services is still being a bit distorted, which is another sort of troublesome situation, gradually resolving, but slowly. And then we've had this conflict in Europe. And so, you know, the consequences have been, we've had these really dramatic economic recoveries, which no one really expected. We've got this surge in inflation and we've had this big deflation in asset prices. So none of that should be a surprise to you, I don't imagine, but it's good to see sort of like a summary. That's what we've got. So look, inflation is the big issue and it's probably most problematic in the United States, and the rest of the world is kind of caught in their shadow, including us. I think the world's inflation is partly come from the United States, like we've got it here. But if you want to go back to the source of it, it's probably the fact that they gave too much stimulus to the US economy. It was the best intentions, but it's probably overcooked things. And the demand for US goods and services from US citizens has overflowed to the rest of the world, and we've all got it. Europe's got it, Asia's got it, Latin America, and so on. And you can see here, I've got 70 odd years of inflation history. The inflation we're seeing is a little bit unusual. There was a bout of this in the 70s and early 80s, but outside of that, it's rare to have this kind of inflation in peacetime. And it's jumped quite a lot, and it's not really coming down a lot. But look, this is an area where people are just a bit uncomfortable with the progress, just hasn't been happening. What I would say to you is that it does tend to lag. Like inflation coming down is probably one of the last things we're going to see in a proper full-scale manner, because to get it down, firstly, policy has to tighten, then economic growth has to slow. All this takes time. There are lags in all of this, and then eventually inflation will come down. But, you know, people want some instant gratification, at least some comfort, and it isn't coming down a lot at this kind of headline level. And so that's contributing to the anxiety, because it's sort of creating this concern that the tightness is going to have to get greater and greater until everything's quite strangled. And that's where we're at right now, but that picture could change fairly quickly in the coming months. And you're not getting much of that message. You're getting a very pessimistic message everywhere. Like people that were pretty relaxed early in the year when we thought you should be very cautious are now getting very anxious when we think you might be starting to see a turning point soon. So keep that in mind. Sorry, I just went backwards. Right. So I am going to move quickly. So just to highlight some of the progress, commodity prices are falling. There are some areas of inflation moderating, and we've had a big adjustment in interest rates and in share prices, which is what we need to get on top of the situation. And for investors, although that's been extremely painful, it leaves a better position now for future returns. And so I just want to quickly review that and then talk about what comes next, why there's so much anxiety, but why that might resolve a bit more favorably than not. So look, you don't know, we're going to have a resource conference over the next few days where commodity prices will probably be what everyone's talking about. So I don't want to labor the point, but if you look across the spectrum, prices have been coming down in most categories. So, you know, I won't labor this too much, but in agriculture, metals and energy, you've had 10, 15, 20% fall. It wasn't that helpful that OPEC cut production just recently, but you're still getting a bit of an adjustment there. And this is offsetting the surge in those prices through 2021 and when we had the conflict start in Ukraine that have been a pretty significant contributor to the inflation. So that reversal is a good thing. And if it goes further, all good. That's a good thing too. If you look at inflation and you break it down into the inflation in goods and the inflation in services, and here we've got the US and Europe, US on the left, Europe on the right, you can see the inflation in goods is already reversing quite a bit in the United States. Again, you don't need to be told this. We've all lived through the pandemic. Spending was restricted, couldn't go out and engage in services like travel or hospitality. So everyone bought a lot of goods. Goods prices, whether it was cars or furniture or IT, went surging. They're now reversing. So that's a plus. The other problem was that the supply of those goods got restricted because of lockdowns and manufacturing companies being impeded. The prices of commodities went up, which drove the cost of those goods up. Freight, shipping was all a struggle. That's all getting better. And so we're seeing that improvement. But unfortunately for services, which is where everyone has shifted their spending to travel again and catching up with all those, nice experiences that we've missed, you're getting inflation going up there, unfortunately, at the moment. So that's partly why the problem isn't completely resolved. And look, I won't talk too much on the charts because we've got to keep moving, but you can see for yourself what's going on there. So it's not to say there's no progress. There is some progress, but it's not complete enough yet by any means. But it could keep coming. We don't know what's around the corner. More deflation in some of these goods would help the picture. And if the labour costs growth, which tends to drive the services inflation because it's mainly a people's business, if that starts to moderate a bit more, and I'll show you some evidence that it's already starting a bit, that's going to be a good thing as well. Okay, sorry, there's a little bit of info. This is probably the busiest picture, so once we get through this, you'll be fine. But I just want to show you the adjustments we've seen in interest rates. On the left, you've got the US markets, and on the right, we've got Australia. And so there's three sort of measures on each. We've got the central bank policy rate. In Australia, that's set by the Reserve Bank. In the US, it's set by the Federal Reserve. That's the bottom one. Then you've got the 10-year bond rate. And the reason I use that doesn't get as much attention in Australia, but in the US, it is a key interest rate at which a lot of borrowing and lending is kind of priced. For example, in America, mortgages are generally fixed rate. They're for 30 years. So these long-term rates have a big influence on the housing market. Same in the debt, corporate debt. A lot of it takes place at 5-year, 10-year fixed. These rates matter. And then you've got the equity earnings yield, which is basically the company earnings or the aggregate earnings of the listed companies relative to the prices. It's the opposite of a price earnings ratio. It's upside down, but it makes it comparable to the interest rates. Anyway, the simple takeaway is they've come up a lot. If you look at, for example, the United States, the red line is back to where it was 15 years ago, which is about where it was in normal time. So we've had a fairly big normalization. And the importance of that is history shows that will start to unquestionably slow things down pretty soon. Just takes a little while. You've also seen the adjustment in the stock market, which has driven that yield measure up as well. And the same in Australia, pretty similar sort of scale of developments. Now, these might go a little bit further, particularly with the policy rates. The central banks are telling us there's more to do, but it wouldn't be a surprise at all for that to have run its course either late this year, early next year would be what we'd be thinking about, because by then you will have had, by historical standards, a pretty significant change in the financial conditions to help address inflation. And so if you just do look at the price earnings ratio of these markets, they've come down a lot. And this is the inverse of that earnings yield. And in the American market, it's back to a normal type of ratio, 15 times earnings. And in Australia, it's even a bit lower at about 13 times. But that's partly because I think the market feels that the resource company earnings are a bit elevated by the still fairly high commodity prices. So look, a lot of progress that you won't really get many people who are bearish making much of, but I think it's pretty important. A lot of pain had to be absorbed to get that progress, particularly in the financial markets. What comes next? Okay, well, so I'm going to just run through these things before I wind up, and then maybe we might have a minute for questions. But what we've seen in the last month, which hadn't been there earlier in the year, was a real escalation in the volatility. Some people refer to it as turmoil. I'm going to talk a bit about that. That is a what do you call a downside risk? There's a risk that sort of doesn't settle down, and then that's sort of something that might go wrong in the system. Are we going to have a global recession? I think there's a reasonable prospect of that now, but it doesn't necessarily have to be a really deep one. I'll talk a bit about that. It could be a deep one if there's a miscalculation, and definitely can have a miscalculation. And I'll show you some reasons. Is Australia immune? I think we have some immunity. We have a better situation here. So then if you're thinking about investments, obviously you're going to have a fair bit of your investments in Australia. Here, the outlook's even a little bit better than some of these other places where we've already had a reasonable adjustment. And then finally, what does it mean for the markets going into the end of the year and next year? Here's a couple of measures of market volatility. The top one is bond market volatility. It's all it is the day-to-day up and down in the 10-year interest rates. How much they go up when you woke up one morning and read about what the US markets did the night before. What do they go down the day after? How much are they going up and down? You can see that started to creep up quite a bit. It's a monthly average as well. Some days have been much sharper. It's gone up quite a bit. And then the stock market volatility has been creeping up as well. What's all this about? I think what it's about is the fact that after 9 months of weak markets, and it hasn't just been shares, commonly it's fairly concentrated in shares when you have a transition in the world economy, but this one's also been affecting property. Fixed income investments have been as weak as shares. They're often considered defensive. They're not been at all defensive this year. I think the consequence of that now where we are today, and no one has a lot of clear sight as to this ending, is you've had amplifying stress. People have been sitting on losses and the losses have kept going and they can't see an end to them, so they're selling. And you're getting a fire sale, in some cases because there's no alternative, like in Britain with the pension funds. Other people are just bailing, and it's added to this up and down day to day. And it's a sign of the stress, which is something you can't take too lightly. But listen, I think if the Federal Reserve gets finished what they need to do in the coming months, the stress will really start to abate. It'll mean that the bond market will stabilise, and that's one of the sources of stress. And I think there's reasons to think that's possible, though not guaranteed, but possible. So these stresses are there at the moment. You can't take them lightly. Something could crack. And if there's a miscalculation, and in the 2008 financial crisis, the collapse of Lehman Brothers in hindsight was probably a mistake. It could have been supported and saved. They thought they should let it go to prevent people thinking they can endlessly take risk and get bailed out. Well, something could go wrong. So don't get me wrong, we're not too complacent, but hopefully common sense and will prevail. What else is a potential risk? The issue as well we've got is that every country in the world is raising interest rates at once. And this is a 50-year history comparing which countries are putting interest rates up and which ones are putting interest rates down. And it's very skewed. It covers about 40 odd countries. The question is, are they all aware of what each other is doing? Probably not. Although encouragingly, the Federal Reserve, the deputy chair recently in a speech said very mindful of what's going on elsewhere. So there's a potential coordination problem here, lack of coordination, because each country's tightening will spill over to the other countries. So that's another risk at the moment. But again, what's tending to drive this is this sort of rapid escalation of interest rates in America has driven up the US dollar. It's driving down all the other currencies, including the Aussie dollar. And that sort of brings the inflation more into the local economy. So all these other countries are trying to prevent that by responding to the American tightening. The only country that's not really doing much of that is China, because they could use a bit of support because they've got their own issues. So when the Americans slow it down, I think this risk will abate as well. Okay. Why will they slow it down? So people are anxious because there's no let up in inflation, no easy wins yet. They're also anxious because there's not much sign that the US economy is responding much to these higher interest rates. But it just took time, and I think they've only been raising rates for about 6 months. And the lags are famously, as Milton Friedman, that famous American economist, said, they're long and variable. They take a while. People try to look at leading indicators, and this is a leading indicator in yellow. The growth is going to go backwards at some time in the next 12 to 18 months. What this leading indicator is the yield curve. It's the difference between the 10-year interest rate, which is a rough estimate of what people think is the normal long-run interest rate, and the 2-year interest rate, which is the one in the next couple of years. And at the moment, the 10-year is less than the 2-year, which is just a simple measure that says things are really tight at the moment. Is that going to slow things down? And the history says it will. And there's no exception in post-war, this indicator has not been wrong. It doesn't always get the quantum of the weakness, but it tells you there's going to be weakness. And the Federal Reserve is not naive enough to not be seeing this sort of thing. There are other leading indicators. Just overnight, we had a housing market sentiment index, which was tanking big time. So it wouldn't be a surprise at all for very soon the Fed to try to slow it down. They don't want a train wreck if they can help it. Do they need to have a train wreck to get rid of inflation? I think the answer to that is no. They probably do need a bit of a recession, but not a deep recession. And I'm coming towards the end. And this is one of my last charts, but basically what this shows you is something, if you did economics at uni or anywhere, to get inflation down, particularly wage inflation, you tend to have higher unemployment. Makes the labour market looser, means there's more people to hire, don't have to pay as high wages. And in America, it's a pretty consistent relationship. So just to show you, to get the wages growth, which is brown, down about 2 to 3%, the unemployment rate, which is in green, probably has to go up 2 to 3%. And that is about the scale of their challenge. So 2 to 3% would take them up to about 6 to 7%. But it's not the 10% of the financial crisis or the 15% of the pandemic or the 25 to 30% of the Great Depression. It's what you would call a moderate recession. And that's probably the most likely outcome if you think the Federal Reserve knows what it's doing, they can read all this and they see what's needed. It could turn out better, it could turn out worse. You can already see with the brown line, it's rolling over a bit, so the wages do seem to be coming down. And we're seeing vacancies, job vacancies are already starting to fall quite a bit. So they're making progress. The task is substantial but manageable. It could still keep getting away from them. There's no guarantees here, but equally, you could get some things go their way, and that would help make an even better outcome over the next couple of months. But I think the base case is they're not going to keep cranking up rates like this for a whole lot longer, and that will take some stresses out of the system and get us closer to some success. Even if they don't get on top of the inflation altogether in the next 12 months, they just get it down to something more manageable and then just keep fighting it gradually over time. That's a possibility. And then, like, lastly on Australia, that chart there for the United States, I've mimicked for Australia here. And this is key because this is the big difference. In Australia, we've got unemployment at an equally unprecedented low, but it hasn't generated the same wage inflation that you saw it has generated in the United States. And so we don't have this underlying inflation problem. We've got a headline inflation problem largely because of global inflation. If we don't let that get out of hand and we don't get a big catch-up round of claims by workers, and it's so far from what I can tell with the Labor Party and the union movement and businesses, common sense is prevailing. Everyone realises it's going to have to just take about a year of like tougher cost of living. That will help us get to the other side without necessarily having to have even the sort of downturn that the Americans have to have. So for example, if they need unemployment to go up by 2 to 3%, we probably don't need it to go up by any more than half that at the moment. But if the darker line at the bottom starts to climb quickly and it's just lagging and we're just not seeing it, then we will have a bit more of a challenge. So for our capital markets, for our economy, we should be looking at a better path at the moment into 2023 than even for the US capital markets and the global capital markets and the economy. So just to finish, you always get episodes like this. I know it's not much fun. It's been a pretty tough year. I haven't found it very easy myself, and it's always a lot nicer when markets are generating strong returns. So this little chart just shows you that in different parts of the economic cycle, investments respond differently. You better take it in quickly because I've got 1 minute 45 seconds left. So what you can see is that we have been in the period over to the right, late recovery, where bonds and shares have been going down, commodities have been coming up. We're transitioning across the recession phase, but we might move through that reasonably quickly. It tends to be the shortest episode in these sort of full cycles, and we could move into the recovery phase sometime next year. maybe economies will be a 2024 story, but markets might start to factor that in 2023. So as I said, we've tended to encourage our clients to think more about having some positioning again. Things could go either way now, but not necessarily inevitably downward. And we've just published our quarterly Australian Investor magazine. And if you want any more color on that, our actual specific portfolio advice, it's all there. You'll be able to pick up a copy from our booth. And that's probably going to get me finishing right on time, which I'm really delighted about.
It's a very slender stage, so it takes me a lot to get across here. Did you notice that, everyone? It's a very slender stage. I had to jump on the front. You came over here yesterday from Sydney, managed to squeeze on a plane. You're not staying for the rest of the day. How long are you going to stay for, Tony?
I have to be back at the airport in Perth by about 1:30. So
1:30. So how much longer are you going to stay for?
as long as I can.
All right. Okay. Do you want to flip? I'll give you 2 minutes for a quick question. Anyone got any questions out there that you'd like to ask? All right. We're going over here. Let's go to this side. Introduce yourself first. Say hello to everyone and ask the question.
Hi, Mark Keane from Precision Exploration Drilling. Question about wages and employment growth. Your chart up there, it seems to show probably a different picture to what we see on the street. I feel that wages are going to be very strong, growing very strongly over the next sort of 12 months. And employment, I don't see any reduction, any growth in the unemployment rate. Your comments, please, as compared to your chart.
Any increase, you think? In unemployment?
Correct.
Yeah. Oh, yeah, there's nothing yet. I mean, in fact, I think today's Wednesday, right? Yeah. There's a labour force survey tomorrow for September. So that we'll get another reading. That's the monthly one from the ABS, Bureau of Statistics. Yeah, you're right. It hasn't kicked up yet. Job advertising has started to plateau and has actually come down a little bit. That's a good indicator of what will happen to unemployment pretty immediately. So it's just a matter of time. Interest rates have been going up. It takes a while for that to flow through to borrowers. The banks have been telling us they don't even change people's repayments for a few months. And then we've got a lot of people on fixed rate loans that won't get reset till next year. But it'll slowly take its toll. And other things are going on, like asset values are down. So look, I think you'll get that effect, but not straight away. The wages growth, you might be right, it might accelerate a bit more. That's the risk. It is a bit of a slow moving system because you have such a big part of, about a quarter of it is enterprise bargains, which they roll over slowly because they're 3 years generally. And so it might be more incremental. But it is the uncertainty, but at the moment it doesn't look too bad. And I think we've got a reasonable chance that it'll be okay. But I take your point. There are a lot of wage pressures, particularly some areas more than us, probably over here in resources.
Yeah, just a quick one. Lindsay Dudfield, Jindley Resources, with the interest rates potentially starting to taper in the US exchange rate, US versus Australian dollar.
Yeah, look, that would, I mean, if they do start to slow it down, like we've already had the RBA start to slow it down, although they keep saying they're going to just keep going. But if the Federal Reserve can start to slow it down, I think quite quickly you'll see the peak in the US dollar and it might start to come back a bit and it'll really relieve everyone else quite a lot and probably relieve the stresses in the system. Things could go wrong, like no one's got a crystal ball and there are big challenges, but I think we've already made quite a bit of progress. And at the least, I think from this point in markets with, you know, the US equity markets down 20-25%, our market 10 to 15%, bond markets are down 15 to 20. That's unprecedented, that weakness. Property prices are falling. Like the prospects going forward now become a bit more two-way. And there's a cost to going in the market too early for sure, but there's also a cost staying out too long. So that's what we're trying to get people to think about, even if they stay bumpy for the next 3 to 6 months. Rather than at the beginning of the year where it looked like things were so high they would have to correct. I think it's a little bit more two-way now. Is that allowed? 2 questions? Where do I see the what, sorry? Oh, well, forecasting equity markets and bond markets is easy compared to the currency. Why don't you ask me a hard question? Alan Greenspan said the best guess was, sorry, the best forecast was a guess. He knows more than me. Now, look, I think probably, given we've had such a period of strength, the US dollar's at a 20-year high, it's up nearly 20% this year. Probably it will be maybe a bit weaker if the Fed, in a year from now is reversing a bit, it's possible. But look, it's not something I'm bothered.
We're going to have to leave it there. Thank you so much. Well done. Thank you very much. We've got an hour of you here at the conference before you take off. Is that right? Good on you. Okay, thank you. And hello to Marcus out there who we know is watching. Matthew, would you like to come up and join us there? And would you like this microphone or use that one? Okay, not a problem. So our first presentation from our investment opportunities for you, ladies and gentlemen, is coming to you from Red Dirt Metals. Matthew is their MD. They've got the accelerating of the development of the Mount Ida lithium project happening at the moment. They've already got key approvals in hand and they can transition to production rapidly compared to some of the other lithium explorers out there. They've also got, in addition to Mount Ida, they've recently acquired the Yinathara lithium project, and that provides really significant future opportunities for them. Would you please make Matthew very welcome, everyone?
Thank you, everybody, and good morning. Hopefully you can hear me properly. Red Dirt Metals, we commenced as a company about 12 months ago now. We started with the acquisition of what is now our primary asset, which is the Mount Ida lithium project in Western Australia, just 230 km north of Kalgoorlie. Accelerating towards lithium production, we started with a raise earlier this year of around about $22 billion. Since then, we've put 60,000 meters of drilling into Mount Ida in both exploration and drill out. When we picked the asset up in September, October of last year, during our evaluation, our due diligence on the project, we discovered that there was lithium-bearing pegmatites on the asset. Since then, and as of today, 12 months later, this morning we actually published our first maiden resource estimate, which I'll get onto in a minute. We put about 28,000 meters into the actual resource areas themselves. It's located on granted mining leases in Western Australia. So I'll harp on about the mining leases aspect and what that gives Red Dirt, and the fact that it gives us a speed and facilitates basically access to putting that asset into production as fast as we physically can. Heritage approval in place. We have no environmental issues, and all our environmental approvals are in place for us actually to start mining. We've, as I said this morning, we've put out our first maiden resource estimate after 12 months of drilling, which is a fantastic milestone for Red Dirt, and we're focused on delivering the asset and an accelerated path to market. We want to be part of this buoyant lithium market. We want to be selling our product into a market where we're getting $3,000, $4,500, $5,000 per ton of SC6. Where are we? The asset is located 230 kilometers northwest of Kalgoorlie. It's has very good access to excellent infrastructure. We have rail and road down to Esperance Port and road across to Gelton Port, which is probably the primary location for us to export our product out of. We have a camp on site. We inherited quite a bit of infrastructure when we picked the asset up in late 2021. We have co-owned an airstrip next door, so 5 kilometers away. That airstrip will be up and running in the first quarter of next year. Again, located on granting mine leases. 2 of these leases, mine leases, are the oldest in Western Australia. One of them will be the first one that's actually renewed for a second time. This gives us a distinct advantage with regards to actually putting the asset into production. It means we have much less regulatory work to do, much less approvals to ask for. It gives us basically between a 45 and 60-day timeline for once we put our mining plan into DMRS before we're actually granted permission to mine. It's on a mining lease that's been mined since the early 1900s, so it's a disturbed area. We have no native title. There's no title claim over our area, and we have heritage approvals in place. And what we have is a significant lithium footprint, and we've only been working for about 11 months to 12 months on the asset. It's an asset that provides enormous upside potential. It's an asset that's never been explored for lithium previously. It's an asset that's only ever been explored for gold and silver. When we acquired the asset, we threw 4,400 drill holes, to give you an idea of how large the database was on the asset. There's 155 square kilometres of tenements there. And of those 4,000 drill holes, only 15 of them had lithium assays in them. That's what initially gave us the impetus to go and actually search for lithium. We've done our exploration bit back to front at Mount Ida. We've basically drilled out areas of 2 to 3 known positions of pegmatites. And now what we're doing is going back and actually doing systematic exploration over the rest of the project area. Major milestone for us today, this morning, our first maiden mineral resource estimate. Mount Ida has approximately 13 million tonnes of 1.2% Li2O, containing 148,000 tonnes of Li2O metal, Li2O, sorry, and tantalum grade of 207 ppm, so a good tantalum grade as well. You can see down the bottom of the slide there, that's the 2 3D models of the sister sand, which is the pegmatite on your right-hand side, the larger one, and then the antimony pegmatite on the left. The pegmatites are dipping between 45 and 60 degrees from surface, up to 35 metres in thickness. They represent a possibility or potential for both open pit and underground extractable resources. At the moment, we are now moving as fast as we physically can on two fronts, primarily looking at the possibility for us to develop a DSO project, which is similar to what other juniors have been doing in the space over the last 12 months, and also running a full scoping and pre-feasibility studies, which are now commencing this last quarter. We're also, post the resource estimate, I think I was personally a little bit disappointed in the amount of conversion into indicated that we had on the asset, considering the amount of drilling we've done, but our consultants were quite strong on that point. So what we're doing now between now and the end of the year is putting a concerted effort into converting as much of that inferred into indicators as we physically can. We're probably looking at around about another 8,000 metres of drilling that we need to put into the asset to bring those inferred category material up into indicated, and we'll be releasing an update on that resource as soon as we physically can. Again, they're located on grading mining leases, as you can see in the background. That's the old tailings dam at Mount Ida sitting at the surface. So us going in there and putting in the mining operation will only, one, clean up the area, and also we have no regulatory issues when actually moving forward with those approvals. The sister sand pegmatite. The sister sand pegmatite is probably the main pegmatite on site, and will form the basis of any future mining activities and the upcoming PFS and scoping studies. The sister sand pegmatite itself is around about between 15 and 35 metres of thickness. The grades are up to 2.5% Li2O. If you have a look at the central section from about 250 metres to 100 metres below surface, we have a slab of mineralisation there with an average grade of around 2% Li2O. There's 3.5 million tonnes of indicated material in the sister sand antimony pegmatites. These will form the basis of what we see is going to be the early years of production. The mineralisation is going to be accessible from an open pit operation. At the moment, we're looking at probably a 50-50 split between an open pit and underground. We have a mining study underway. The results of that mining study will be published in probably the next 4 weeks. In conjunction with that mining study, as I said previously, we're looking at the options of producing a DSO product and selling that to market. We have an in-house lithium expert who joined us earlier this year. Mr. Gao here came over from Mitsui. His primary objective in the next 2 to 3 months is to see what appetite there is in the market for a DSO product, to see how quickly we can get this asset into production and how fast we can actually we can make that transition from explorer developer into actually producer. If you walk out of the building today, and there probably aren't many 7-story buildings in Busselton, but if you do walk out and actually find one, that gives you an idea of the sort of thickness of what you're looking at with regards to the size of these pegmatite bodies. One other good aspect about the sister sand pegmatite is we can be very selective. We have no internal waste in the product, so no requirement for us to all sort on the material that's coming out of there. We have a high spodumene content, and our initial metallurgical tests that we've done so far produces both a DMS and flotation concentrate with recovery values between 50 and 75% on the resource itself. The lithium market buoyancy, I'm not going to dwell too much on this because I think a lot of people are going to cover where we're at in the lithium space at the moment. I think the one point we do want to concentrate on is the fact that whichever way you look at it, government policy and decarbonisation across the world at the moment is going to keep demand for lithium high. We, as a company, want to be in a position where we're selling into that market. Speed to market is our mantra. We need to be able to reduce our risk or financial risk going forward by producing cash flow as fast as we physically can. We need to be able to make sure that if the company can at all be selling into a $5,000 per ton C6. You've seen what that's done for cash flows for the likes of Pilbara Minerals, for the likes of the core infrastructure production, mineral resources. Immense amounts of cash being produced over a very short period of time, cashing in on what looks to be a market that's going to be in deficit for at least another 5 to 10 years. I'm not an expert on forecasting metal prices, but I do see that at least in the next 2 to 3 years, and we want to be producing within that time frame, we're still going to be selling into a very strong lithium market. Our mantra again is speed to market. Because of having those granted mining leases, because of having no environmental issues, no heritage and native title over our projects in Western Australia, we have a distinct advantage with respect to other junior players entering the market in the next 12 months. Corporate overview, usually a slide to put at the front of the presentation, but dropped it down because just want to put a gap between what we've done and what we're going to do in the future. I guess the big takeout from this really is the David Flanagan joining the board as chairman. David, as you probably doesn't need a lot of introduction, he's set up Atlas Iron, was also chairman of Battery Minerals and on the boards of Northern Star and Macca. So fantastic experience with regards to corporate level experience in Western Australia and on mining companies in Western Australia. I think between myself and David, we've built 7 mines. It gives, basically what it gives Red Dirt is the capacity and the capability to put together a team to build a mine and advance the projects faster than our competitors. And that's what we're going to do. The focus on Red Dirt and on the next 12 months for us is to basically get Mount Ida to be producing. That is our first and primary focus. And I think we can do that. We have, like I said, we have a good technical board in place at the moment. And we have definitely the drive and impetus to actually get that asset up and running. Major shareholders, Waratah Capital, we've got a very strong shareholder register. About 50% of our shareholders, our shares are held by institutions and the board. Doesn't help with days like today when you get some good news out and get sold down. Not a lot of movement, but I think it does show the support there is on an institutional basis for the company and the belief that we have, the belief that the investors have in us going forward. New lithium province. This is just to go back, take a step back to where I started with Mount Ida. We picked up 155 square kilometres of tenements when we picked up the asset from Orabanda in late 2021. The key takeaway from this point is, as you can see in the middle of that slide, this is a large granitic intrusive body. In Western Australia, apart from Greenbushes, I think it is just about every lithium LCT bearing pegmatite is located within 0 to 5 kilometres of an intrusive granitic or wet intrusive granitic, something that is the source of the lithium bearing minerals, and then they are placed into the associated mafics on the borders of that granitic intrusive. That emplacement always happens within what they call the Goldilocks zone. So you get a fractionation within the pegmatites between 0 and 5 kilometres from that contact zone. We have in our tenement package there at Mount Ida approximately 22 kilometres of strike of that Goldilocks zone. When we picked up the asset, as I said before, if you look down in the bottom left-hand corner, there were 3 pegmatites on there. Those 3 pegmatites are the Sister Sam, Timonian and Sparrow pegmatites. They are what formed the basis of our initial resource estimate that we published this morning. The rest of the asset, or the rest of the ground, has been only sparsely explored. We started with a geochemical PXRF study early this year. From that, we followed up with 380 air core holes, which are in the lab at the moment. And after those results come back, then we will start in earnest exploration on the rest of the project. 2 minutes. Multiple zones of pegmatites. This just gives you an indication of what the potential upside is close to the existing resource that's just been published this morning. Down on the right-hand corner, you've got the Sister Sam, which is 5 to 7 million tonnes of pegmatite. Then again, 4 to 5 million tonnes of antimony, and the Sparrow North project, which was only found 4 months ago. So that is an all-in inferred Sparrow. But as you said, we've only found that 4 months ago. It gives you an idea of how quickly we're bringing these things into resource status. We are very aggressive. We put 60,000 metres into the ground so far. We are going to put another 40,000 metres in up until the end of this year, from when we publish this resource until the end of this year. Then we start on regional exploration in what is probably the most exciting thing that's happened to the company besides the resource estimate, which is the acquisition of the Nithara Unithar represents what we think is potential for a very large discovery of pegmatites. We have over 7 kilometres outcropping pegmatites at surface. The Unithar project has 520 square kilometres of tenements, and one of the main aspects of it, again, was being able to secure a tenement package over what we call the Goldilocks zone. If you have a look at the image there, 500 metres down left-hand side, there's only been 34 drill holes put into this asset. We start drilling in early November, and hopefully we have both visuals and assay results in December of this year. It's the right mineralogy, up to 35 metre thick pegmatites. Of the drill holes drilled to date, the 34, 15 of them came back with spodumene in them. We've got assays up to 25 metres at 1%, and it's only been drilled to 100 metres below surface. Thank you very much for your time, and I'll hand you back over to Chrissy.
Thank you very much, Matthew. You're one of the fastest speakers I know. Imagine what you could have got through if you probably talk that fast at the end through the whole thing. But we can come and talk to you in the booth. And that's the big thing about this, is we're giving you the chance to have a chat with our speakers and connect with them. Andrew Ferrier, you're just sneaking up here, are you, sir? Have I invited you up here yet? That's all right. Good. Go stand over there. That's all right. This is Andrew Ferrier. So Okapi Resources is next up on the stage at Southwest Connect, and they're giving themselves a bit of a dominant position over in the US at the moment, as the US and Canada goes towards that zero net carbon emissions by 2050. So a dominant uranium position. I should have headlined that one, shouldn't I? So this is Andrew Ferrier. He's the Managing Director of Okapi, and he's here today to share with us the company's very exciting progress. Please make him welcome.
Well, thank you for that very kind introduction, and it's great to be here at the conference today. 15 minutes isn't a lot of time, so I think there's a few really key points I want to get across to people about what the story of Okapi Resources is. So very focused on uranium in North America. We essentially have a very substantial asset in the Tallahassee uranium project, which is in Colorado. It's 50 million pounds. It's a big asset. It can get bigger. We also have 60,000 hectares of exploration properties in the Athabasca Basin. And for people who don't know, the Athabasca Basin is sort of the elephant country of the uranium space. It's where the highest grade, biggest deposits exist for uranium in the world. And on top of that, we also have a gold project in New South Wales, which we just finished drilling out and had some pretty spectacular results on. So we have a lot of assets. We have a team that knows what they're doing. My background is in mining private equity. I spent 6 or 7 years living in North America, where I was directly responsible for pretty sizable uranium investments we made in that part of the world from sort of 2011 to 2018. I was actively involved in the US uranium space. Brian Hill came on, the chairman, very credentialed, highly experienced mining executive based in Denver, Colorado, which is close to our assets. He was, ex-CEO of Newmont, very established guy. We've got Jim Villeneuve as well, who's based in Colorado. Basically, he was working with me on the Reno Creek asset, which we took from sort of pre-scoping study, pre-resource all the way through and received the final sort of NRC permit on that project. So we've got the team that's actually, very few people have actually taken a project from that position and got it permitted in the US over the last couple of decades. So we've got the team, we've got the assets. Our market cap today is relatively modest, it's sort of $35 million today. We've been very active on our assets over the last 6 months. Got really good substantial inside ownership, which I think is really important for shareholders looking in and trying to understand the alignment of the management team going forward. But I always like showing pictures. In the top right-hand corner is our geologist in the field up at our Noonan and Perch projects in the northeast of the Athabasca Basin. We recently put out the summary of the findings of that summer field program. Very exciting land, very exciting position, sort of working very aggressively to hopefully go and drill those targets out as soon as possible. And then in the bottom right is our diamond drill rig on our Emerald Gold project in New South Wales. And I'll touch very briefly on those results that we put out to the market. At the moment, we've only announced 2 of the first 2 holes, which are impressive, and look to get out the remaining holes very shortly. You can't talk about uranium without talking about geopolitics. It's as simple as that, and why you want to have assets in the US. And basically, this is probably the best slide that sums it up, where the US is at the moment. And a lot of people don't really understand this in Australia, but nuclear energy still accounts for 20% of all the energy produced in the US, which is a big number when you think of the size of the US economy. But probably more importantly, it's 50% of their clean energy. So all the money they're putting into solar and wind over the last decades, which is billions and billions of dollars, nuclear energy is still 50% of their clean energy. And this is a country that is completely committed to clean energy going forward, and is completely committed to basically electrifying their entire, every car that's driven in the US. So this means that they're going to spend a lot of money building out and maintaining their nuclear reactor fleet. So the US consumes more uranium than any country in the world, but for a long, long time has produced very little uranium themselves. And this wasn't really a problem or a major concern for the administration until Russia invaded the Ukraine, and the US administration woke up and found out that they were actually importing and reliant on nearly close to 50 to 55% of all the uranium coming into the US comes out of Russia. And this is not a good position for the US to be in. They were very quick to ban the importation of oil, gas, and coal after the invasion, but they didn't do it for uranium because they couldn't. So what they're effectively doing is a whole bunch of policies coming out. They pumped $6 billion into the nuclear reactor fleet. You may have heard of something called the US Inflation Reduction Act. It was a green energy bill. It pumped $40 billion into the nuclear reactors. So there's no economic reason why these reactors will shut down over the coming decades. And what they need to do now is incentivize domestic production. And that's where we sit with our projects today in the US. So our main, and this is a sort of a peer comparison. It's not entirely apples to apples. We've got a selection of assets, obviously in the US and Canada, and gold assets in Australia, but it gives you some sense for £50 million in our Tallahassee project, our market cap today. There's a lot of room for us to grow in terms of our valuation. This is our Tallahassee project in Colorado. It is one of the biggest uranium deposits in the US. It's been extensively explored and drilled and worked on in the past. Back in the early or late 1970s, early 1980s, a full-blown mine permit was approved on the Hanson deposit, which you can sort of see down there to the south, where the most concentrated drilling is. But the key reason why I show this slide is just to give people a sense for the size of the district. We have 50 million, well, 49.8 million pounds there today. The entire district is probably closer to 90 million pounds. 90 million pounds in the US, given everything that's happening in the uranium space, is going to be a very strategic position for Okapi moving forward. And the other reason I show it is just to show how much work is being done on this project. Over 2,000 drill holes, 350,000 meters. We're blessed to have nearly all this data. So the replacement cost to redo that work today would be obscene. We're obviously blessed to have that data with us today, and we're looking to actively progress this project moving forward. Some of the geology I won't spend too much time on, but just to give you the sense, it's shallow, it's high grade, it's thick mineralizations. It shows all the sort of key, when you're looking at projects, it shows all, sort of ticks all the boxes of what takes an asset at this stage and what, is something that's going to be put into the production going forward when the uranium price moves up from where it is today, which it inevitably has to do. We also have these projects in the Athabasca Basin. We picked these up earlier in the year. We picked up 6 different projects. We've already got a drill permit on Middle Lake project, which you can see out here on the left or on the west of the Athabasca Basin. That's only 3 miles away from the old Cluff Lake mine, which produced close to 70 million pounds. 15 k's away from Shea Creek mine, which has just gone under, which UEX was in a JV with, which has been bidded on and taken out by UEC. It's a very active market. UEC's also just recently bought the Rough Rider asset from Rio Tinto for $150 million. So there's a lot of movement in the Athabasca at this point in time. We're very clear in our focus and strategy in the Athabasca Basin. As you can see, nearly all our assets are on the fringe of the basin, which is important for us because it means we can actually drill into the the contact of the basin or the sedimentary unconformity and the basement rock with relatively shallow drill holes. I'm talking the first 50 to 150 meters. So drilling in Athabasca can be expensive. It is a remote part of the world. So being able to drill effectively and drill out your drill targets, for the hitting your targets, but the shortest amount of meters is really, really important. But we're very happy, working very hard on the assets. This is the Newnham and Perch projects. Been really interesting sniffs of uranium. There's two real clear conductive trends that run through this claim package that we have. It's a pretty substantial claim package. We've been focused out on the sort of eastern portion, really in terms of sitting there on the basement rock. We went out there and got our geos really active there. They were basically 3 weeks in the field, running around, basically taking geochem analysis, a whole bunch of rock samples. And that's really just allows us to home in and focus on what our drill priority targets are going to be. And we're in a process now of really keen to go out and drill these deposits. And this may seem a little bit contradictory, but the best time to actually drill these deposits is in the middle of winter when it's completely frozen over. It just allows easier access rather than in the summertime where it's effectively, think of as a lot of low-level swamplands and it's very hard to actually move drill rigs around. So drilling in the winter is the focus here. This is our Middle Lake project, which I won't spend too much time on. So I mentioned we had our Tallahassee project, 50 million pounds. We've got our Athabasca assets, pretty substantial claim package there. Very keen to continue to progress those assets. We also picked up this Maybell project, which is also in Colorado. It's in the sort of northeast corner of Colorado. Basically went out and staked these claims ourselves, which gives us hopefully gives you a little bit of a sense of sort of our know-how in the US. This is a historic producer, produced over 5 million pounds. We've basically locked in nearly in the entire district. We've gone in quite a huge amount of sort of historic data, which has some very interesting sort of historic resource numbers on, which we're working through at the moment. And I think this is an asset which is a bit of a sleeper in Okapi at the moment, but we're going to get some information out to market hopefully relatively shortly, which shows the true nature of this deposit going forward. On top of that, we have some really interesting claims in the LaSalle district in Utah. LaSalle district has been a pretty substantial uranium producer over the cycles and numerous uranium cycles. We went out, took some rock chip samples early in the year, sort of hit 1.2% uranium. We hit 12% vanadium. These are really high grades. We have a permit to drill here. And the most important thing to really understand about this Utah district is that the White Mesa mill is 100 Ks down the road, which means that which is the only sort of permitted conventional mill in the US today. So there's a sort of a logical place for the uranium ore to go as we progress this asset. And then if all those assets in North America and our uranium assets weren't enough, we also have this gold project, the Emerald Gold Project, not too far from Armidale in New South Wales. We've put in 7 holes into this project over the last couple of months. We've done diamond drilling. We're following up on a really interesting intercept first that they drilled out last year, which was drill hole 6, which you can kind of see here, that was drilled sort of down plunge into mineralization. We've gone in, first drilled 2 drill holes, stepped back, obviously drilled perpendicular as much as we could to the mineralization. And look at some of these results. We're getting sort of 28 meters, 2.5 grams. These are economic intercepts, 5 meters of 4 grams on drill hole 2, another 11 meters of 3 grams. You guys can see all the intercept results here. So this is a high prospective part of the world where we've got a pretty substantial EL in MOR. We have sort of what we call 10 to 15 sort of walk-up drill holes. We were initially focused on just following up on the discovery hole from last year. We've then gone and sort of drilled down strike to hopefully sort of confirm other sort of high-grade shoots that may be in the districts. And in terms of the long-term strategy on our more gold projects, we're very much a uranium company. Uranium is going to be one of the hottest sectors going forward, given everything that's happening in the space and the desire for clean energy. You've seen Japan reverse their policy. You're about to see, I think, Germany reverse their policy. You've seen the UK come out and be very positive for uranium and nuclear. China and India are building nuclear reactors like there's no tomorrow because they understand it's the only form of clean baseload power to keep their economies running going forward. So that's essentially the Okapi story. Hopefully I've articulated to you sort of what the team is, what the team's done, what our strategy is, and why it's important to be in the uranium space, particularly in the US with US assets. So I appreciate listening to the story and happy to answer any questions.
Thank you very much, Andrew Ferrier. That was brilliant. I love the way way you wear your little neck thing too. It's very laid back, isn't it? It's kind of a bit of attitude there. I like it. If you're ever interested in information on uranium, because I love to do a bit of a deep dive onto our presenters that come onto stage. Carl Kruszyninski, you've all heard of him? Dr. Carl, he does a great little piece on uranium. I was listening to him last week and he was talking about the short-sightedness of governments in the way that they can dispose of this mineral, which he thinks has got the answers to all the problems that we have in the world, but he's just talking about a better way of disposing of it, and he thinks that's where you should be going towards. So have a little listen to him just to back up what's being said there by Andrew. Right, where we're going to go to next, team? We are going to go to one of the legends of the mining world, Mr. David Crook. Are you coming to join me, sir? Here he comes. So David is here representing Charger Metals. Now, they listed over 12 months ago and their geoscientists had generated some quality new drill-ready targets on each of their 3 company projects. It's a really exciting time for the company and they're awaiting approvals before the rigs start turning both on. You've got Coates, and what's the name of the other one? You've got Coates and, yeah, 2. So those 2 ones. So this fellow here, come and join us on stage, David. If you haven't met him before, he's got over 40 years of experience. He's a wealth of knowledge, and this is a really interesting project. Please make him very welcome.
We were very pleased to be here last year, and we've made some progress this year, but we're still mining exploration, I should say, in Western Australia is a lot of moving parts. We hear stories about people. Actually, I might use the thing. This is pretty fancy. Thanks very much. It's a lot of moving parts. First of all, you need tenements, you need people, and you need, well, a supportive government to get you going places. And I suppose the last 12 months, all of these things are moving. We've had the ability to put together a particularly good team of people, and that's help us to get to this point. The government processes are keeping us very, very well frustrated. A lot of my grey hairs. My wife said to me during the week, David, when you went to the barber last time, he cut out all the black hairs. Well, I can tell you it's been the government and the agencies that have caused that. Anyway, that aside, we have 3 projects, as Chrissy referred to. The ones that we'll talk about today are Bino, just out of Darwin, and we've heard people refer to the Core Lithium project earlier today, and we are in amongst those people. The one that I'm most excited about at the moment is Lake Johnson. We hope to be drilling there next month. The Coates project, we did put a couple of holes into, and we're still waiting for the drill results from that. Now, talking about people, Chrissy said that I've had 40 years experience, and she used a very kind word. Other people say stalwart, which means you're getting very old in this industry. The fun that we've had over the last few years, though, she referred to us being in the lithium space for quite a while. The team around us discovered the world's only specifically cesium deposit. So when people talk about LCT pegmatites, there's the lithium, of course, which we hear about. The cesium, nobody ever hears about. And then tantalum is often a byproduct in these things. But we had a lot of fun putting together a cesium mine. After that, we did discover a spodumene deposit, and that will come into production with another company at some stage. But the team around us, many of the same people, and we're in the throes of doing it again. We heard the last speakers talk about the Goldilocks zone. Well, one of our consultants, Nigel Brand, in the audience, coined the phrase Goldilocks zone, and that's one of the areas that we've been working at, for years now. Other people, Terry Gardner is a well-known stockbroker. Adrian Griffin, he probably is one of the stalwarts of the lithium industry. Lithium Australia was certainly one of the first movers, and our portfolio was acquired from Lithium Australia, and that's where we've been able to get such a great group of tenements. Brian Dixon is also in the audience. He has helped manage many companies. He's a wealth of knowledge and keeps everybody business ready from a commercial point of view. Jonathan Smalley joined us. He's a very well-known goldfields geologist, but with a deep depth of knowledge across many commodities. So we have got that team in place. I should add, a nod to Lind Partners, who are one of our big shareholders. So again, a sponsor of this event. So let's talk Darwin. Darwin is just off the top of the map. The grey area that you see is Core Lithium's project portfolio. Ours is an exclusion within theirs. And all of the spots that you see through here are known pegmatites. The Core Lithium people have a resource, and they're currently mining this with a view to doing direct shipping while they build their plant. So as the last speaker was talking about, let's get some cash flow happening, and then we can work away from there. We have flown geophysics over our project, which shows geological continuity between a number of the pegmatites off our ground, and we're pretty much drill ready there. So we updated geochemistry that was in the area. In the Darwin area, because it's a tropical environment, spodumene won't hang around. So very quickly, all of the spodumene is weathered. The best you see are pegmatites sticking out of the ground. And in some instances, they'll have halos of lithium. And that's the way you prioritize where you're going to be drilling. So these here are lithium anomalies, and these are where we want to go drilling. The process in the Northern Territory is that you get a mine management plan, which is an environmental document. We got that months ago. And then there's an Aboriginal Heritage veneer, which is a government department up there. When we applied for it in March, we were assured it was going to be 150 days. Well, it's a lot more than 150 days and we still haven't got it. We're assured that it's not too far away, but it's already raining in Darwin now. So we've got our fingers firmly crossed that we'll be drilling there this year, but it's starting to look a bit more difficult. This is a photograph of our geophysics. You can see the grain of the country is through there. There's an area called Ahoy there, and there's an area down here called Bilitis. We'll have a look at those in just a minute, off our tenement. But the reason for showing those is that these are quite nice spodumene discoveries by Core Lithium. So it just reinforces the fact that we're in a spodumene field. This is one of our geologists, Stu, standing on one of the pegmatite outcrops. So Ahoy there, these kind of numbers, nice, very significant, good grades of absolute spodumene. Bilitis down here. These are, like I said, all pegmatites. Core did do some drilling in this excision here and got spodumene. Our main targets at the moment are Old Bucks and Megabucks. I think they're very well named, and they're right on the asphalt. This is an asphalt road that goes out to fishing camps. So access is pretty much 365 days a year. And if we can get drilling, we will get drilling as soon as we can. Enterprise is a very high intensity geochemical target. Interestingly, Enterprise 2 is a very strong cesium anomaly. So just with our background in cesium mining, we will be keeping an eye on that, although it won't be our first priority. And same with 7up. That's a very linear, very long, intense lithium cesium anomaly, and we're looking forward to getting drilling there. You might recognise this map from Matthew's presentation. He did such a good job, we pinched it and added Lake Johnson, which was of course missing off his. This is where we plan to be drilling in the next couple of weeks. So we're in a well-established jurisdiction. Of course, Western Australia is a tier 1 area to be mining. We have very good access to the great southern areas. There's a road that goes through to the Norseman Road from where we plan to go drilling. We're very close, of course, to Earl Grey, which is one of the biggest in Australia. So it's a good address. These days, a lot of spodumene is known through these areas, and we hope to extend on that. So this is what our project tenements look like. And the one that we are going to start drilling is down here. There's a big cluster of pegmatites up here. We've done quite a bit of work up there and we have lithium anomalies, but there's quite a bit more work to be done up here, so we won't dwell on that anymore. But from there to there is 50 k's of Nigel's so-called Goldilocks zone. What attracts us down to Metcalfe? The Geological Survey had mapped pegmatites out there, and a Lithium Australia geologist went out there and discovered spodumene sticking out of the ground. So absolutely first prize. So these are rocks full of spodumene. The white crystals are through there are spodumene from here. He mapped them in, and so we've got a swarm of pegmatites. There's up to 20 pegmatites there. The highest rock chip is 7%, so he's very carefully picked out a spodumene crystal and assayed that because that's about as high as you can get. But the generally 2s, 3s, 4s, 5s, irrespective of the number, the fact is that all of these are spodumene-bearing pegmatites. The fellow did an interesting form of soil geochemistry where he sampled the coarse fraction, and that gives us these purple spots here. That box is the same box as this. Now, the things that are interesting are all of the pegmatites that are sticking out of the ground are between these two white lines, but the anomaly continues way out to this way, and there are just a couple of hints of more pegmatites out there. So as far as drilling goes, we plan to put 3 lines through the middle, and then step out 160 metres, put a line out there, and of course, a long line right through there, and let's see what we get. But you know, that's 500 metres long. So overall, the anomaly there is the best part of 1 kilometre long. And so that's a good size as far as spodumene pegmatites go. Mount Day, we will just touch on it quickly. That's a lithium geochemistry. These are big flat-lying pegmatites. There's some cross-cutting pegmatites. The geologists may be interested in that. What we need to find, I believe, in this system is the feeder zones, because quite often that's where the spodumene lingers. So that's a work in progress. Just before I go on, with respect to where we are with the drilling, our POWs are in, our flora surveys have been done, and next week we're doing our Aboriginal heritage surveys. As soon as they're completed, and presumably we get the tick of approval, the POW will be granted. We've already lined up our driller, and so we start drilling. And hopefully that's West Australia's next spodumene discovery by drilling. The Coates project is just outside of Perth. If you weren't heading south, you would have been heading east, and you'd go past Baker's Hill and the pie shop there. The pie shop's about there. So the Coates is a mafic intrusion. We were prospecting it for a Julimar style nickel platinum deposit. We put 4 diamond drill holes into it, and we're waiting on the results. So the model that we used, mafic intrusion here, we had the benefit of some geochemistry, courtesy of some bauxite miners. We were able to re-assay some of their drilling. Got a nice nickel, copper and platinum group anomaly there. We flew geophysics. We did some ground geophysics. We got a beautiful coincident target. And like I said, we put in 4 diamond drill holes, and that's the rig, a nice little crawler mounted rig, very tidy. And we're just waiting for the results from these. So hopefully they're not too far away now. So wrapping that up, we operate in Western Australia and the Northern Territory, Tier 1 assets. 2 of the spodumene targeted projects are drill ready or approaching drill ready. With our heritage surveys in place for both projects, both of them are ready to be drilled. The Lake Johnson one, I think, has got its nose in front. It's got spodumene pegmatites sticking out of the ground, so it's also the company's lowest risk project. And we're looking forward to putting in 40 or 50 holes as soon as we possibly can there. And then seasonal and approvals in place for the Bino project will be up there as soon as we can as well. So thank you very much.
Thank you, Mr. Crook. That was your first time with the handheld, wasn't it? 40 years of experience you've had in that. You did a very good job. Thank you so much. You made a really good point too, when you sort of gave directions to the final mine site there. Who actually is from this area? Who's from over east? Did any of you fly in this room? Or am I talking to all West Australians? All West Australian, fabulous. Well, who's in those bloody planes from Melbourne? They're outside. Thank you, David. They're out there. I went out to grab myself a cup of tea at the indoor station, and there's a load of people out there chatting and chin wagging out there about their investment opportunities. This is a good one for you next up here. Talon Energy. Now they're capitalising on recent drilling and testing success to bring 2 gas and production facilities online in the first quarter of next year. Now they're producing, get these numbers, 33 terajoules per day. And they're joining a short list of producers in the Perth Basin who are generating cash flows of up to $30 million per annum. And this very happy-faced human being that's coming up here to talk about that, because that's almost half their current market cap. It's a really impressive number, is MD and CEO. Will you please welcome Colby Hauser?
Thank you, Christina, for that intro. Thank you to Canaccord for sponsoring the event, as well as the other sponsors. And thank you to Vertical Events for putting on a great show here. I think this conference is an invaluable opportunity for investors to connect with small and mid-cap companies. And I think there's a great buzz. From what I can tell here, I think the current market's obviously offering up a lot of, I think, really good investment opportunities in the small and mid-cap space. So as introduced, Talon's an emerging oil and gas producer with sort of very little downside and remarkable upside across our exploration portfolio. We're coming into $30 million in free cash flow at the end of the first quarter in this year. And that's really a game changer for a company at our current market cap. So we've taken FID already on the project, and we'll use those cash flows to expand our current portfolio and look at new opportunities. So take you through a few slides, mandatory disclaimer and resource information. Okay, so I'll start with the corporate overview, just to sort of introduce how we're set up and then talk to our portfolio a little bit before focusing on 3 distinct investment highlights. After a 20-to-1 share consolidation, we have about 440 million shares on issue. Our current share price is 17 cents, and that puts our market cap right around 75 million. Our cash at the end of June 30 was about 10.1 million after we raised 13.5 earlier on in the year. And after a busy period of development, our cash position sits somewhat lower, with most of those funds sort of earmarked for long lead items and CapEx. I want to talk about debt with approximately $15 million in upcoming CapEx commitments and line of sight to revenues in Q1. We want to bring some debt into our capital structure. We're focused on not diluting the stock, and our discussions with debt lenders are well advanced. We've executed a term sheet with our preferred lender earlier on in the week, and we hope to finalize that facility in the next 4 weeks. So our portfolio is diversified in terms of geography, but also in phases of development. Our working interests are spread across 2 jurisdictions, in the Perth Basin in Australia and the South Gobi Basin in Mongolia. In the Perth Basin, you have a globally recognized conventional hydrocarbon basin. And then in the South Gobi, what's quickly becoming, a world-class CSG destination. In the Perth Basin, we hold a 45% interest in the Watering project. It's a conventional gas and condensate project that's, as I mentioned, recently taken FID. Our partner in the project is Strike Energy, who've proven themselves as one of the best explorers in the Perth Basin. Beyond that, we have another field called Condor, which is looking very good in terms of its prospective resource. Both fields are Jurassic wet gas, which means that there's gas and condensate hopefully available. That's 100% owned, or will be 100% owned by Talon once it's excised out of EP 494. And then in the South Gobi Basin, we're earning a 33% interest in the massive Gravanti CSG project. TMK Energy is the operator there, and having returned from a trip in Mongolia about a month ago, I'm pleased to say that TMK has excellent knowledge of the basin, a great team in country. And they have significant local ownership, which is, you know, a key factor in Mongolia. So adding to this, obviously, there's a ton of demand for gas in both Mongolia and China. So all this added up, it's a non-operated position, but that means our corporate overheads are extremely low, and that contributes to a very capital efficient business. So to these investment themes, imminent cash flow out of Walyering Q1 next year is, you know, easily the biggest investment highlight. $30 million is, you know, far more than sort of keeping the lights on. $30 million on 100% interest is enough to drill and test, you know, 3 wells in the Perth Basin, you know, test 100 core holes or drill 33 pilot wells in Mongolia. And that's every year, right? So it's a real game changer. If you think cash flow is boring, we have exploration upside in spades. Obviously, Gravantes is rapidly developing to service China's energy demand. And the Condor prospect is the largest Jurassic wet gas prospect in the Perth Basin. So, and lastly, we have a number of near-term value catalysts as we transition from explorer to producer. Surprisingly, there's very little precedence in smaller cap companies making that transition. But this change in categorization often sees a company re-rate and trade at a premium compared to an explorer. One specific near-term catalyst is we're expecting the contingent resource to come out of Mongolia in the next couple of weeks, and it's looking to be the largest contingent resource to come out of Mongolia. So let's dive a little deeper into the first investment highlight, imminent cash flows from Walyering. This morning we released an update. There's a schematic diagram, as you can see. Walyering is a low capex, quick to market project. As introduced, it has a nameplate capacity of 33 terajoules per day of gas production and about 300 barrels per day of condensate. The facility to be tied into APA is primarily a gas pipeline, and we announced this morning we've executed our pipeline access agreement. Condensate will start its marketing journey on the Brand Highway. You can see that on the right side of the diagram, and all up, you know, the capex of the facility is, you know, $14 million, which is very low. But in what was a major milestone in announcing FID on the project 2 months ago, we've really focused on a local fabrication and procurement strategy. We're proud to say that 50% of these materials are being produced in WA and 70% in the rest of Australia. So it's been a key enabler to getting our project developed in a quick time frame. Environmental approvals are progressing well, with secondary approvals already submitted and under assessment by the regulator. And our forecast operating costs are well within the lowest quartile of onshore production. So combined with low capex, you know, we think the project is going to have excellent profitability. So Jurassic wet gas means 2 revenue streams. With gas, you get a commodity and a long-term take-or-pay contract. And then oil, obviously, you get spot exposure with opportunities for a pricing run. So we've seen the gas market, you know, double in the last couple of years. The Ventures publicly announced that we expect to see our gas sales agreement finalized with pricing in $6 to $7 a gigajoule. You know, this is a huge uptick from where we were a couple of years ago. As I mentioned, we hope to finalize that gas sales agreement by the end of the year. Condensate daily production should be between 150 and 300 barrels. The condensate at Walyering is really light, and it could attract a premium as it requires less refining. So I think everybody's sort of tracking global energy markets, and you know that security of supplies is becoming a huge issue and is really driving energy prices. Brent's coming off a 5-year high, and you know it's literally the best time to be developing an oil and gas project right now. So between these two products, we can expect at a gross level $50 to $75 million in cash flow, and again that's $30 million up to $30 million per annum net to Talon. So something we're pretty excited about. So if we move to our second investment highlight, exploration upside. We'll first start in Mongolia, and I thought it was important to give some macroeconomic context. You know, for some people, Mongolia is an obscure country, but it's, you know, it's really beautiful with a strong history of resource development. There's a strong fiscal and regulatory regime and a willingness to cooperate at both the provincial and federal level. International companies have spent tens of billions of dollars in country. Like Western Australia, resource development represents one of the largest sectors of employment, and really remains one of the main drivers for future economic prosperity in the country. So they're very serious about developing resources there. There's significant opportunities for decarbonization in both Mongolia and China, with gas substituting, particularly for coal-fired power generation, and an opportunity to replace diesel and heavy transportation. So China's energy requirements are astonishing. Having been up on site, and you're just seeing thousands of trucks drive across the Chinese border, all loaded in coal, right? Obviously China wants to move away from coal, so it speaks to how badly they want natural gas. And it's reported that China's facing its worst energy crisis in decades. So it's a very opportune time to be developing that resource. So Gravantes exemplifies exploration upside to a T. I mean, it's been independently verified by two of the most respected assessors in NSAI and risk, with a gross prospective resource of between 5.3 and 6 TCF. In my mind, that qualifies as world-class. The resource is on China's doorstep. Gravantes is literally the closest project to China. You can see on the border there, that's a 8,400 square kilometer permit. That's 20 kilometers from the border. And even closer to China's east-west gas pipeline there. So the project's had 100% exploration success with great results across the 5 wells we've tested, so much so that there's significant interest from PetroChina to support the project. They signed an MOU a couple of months ago and are looking to be a development partner. And that east-west gas pipeline I just talked to happens to be owned by PetroChina. So it's really shaping up to be an excellent development. So in the next few weeks, as I mentioned, we're working with NSAI to get out the contingent resource for the project, and it's looking to be the largest to date in Mongolia. So just a few pictures from the site trip. On the left, you can see the drilling rig that drills the core holes. It's more of a minerals rig. That's Snow Leopard 5, as we call it, our most recent well. And to the top right is the signing ceremony with PetroChina in Ulaanbaatar, and underneath some gas desorption testing, drilling those cores, of the drilled cores. So this is a really great view of the project facing south. You can see the sort of, the 5 core holes that we drilled, and its proximity to the Chinese border. I was really pleased to see an area of land that's earmarked for, what could be a pipeline. There we go, sorry, the potential pipeline right away in green there. So the project has size and scale, access to a huge market in China. There are next to no surface constraints, as you can see in the topography. And the project has great technical parameters. So I won't spend too much time on this timeline. We've obviously finished exploration drilling, have a little bit of desorption testing to finalize, but that maiden contingent resource in the next couple of weeks. We'll kick off the pilot well program to bring gas to surface and improve the commerciality of it, and concurrently start the 2023 exploration program, which should go throughout most of the year, with a view to having first gas by the end of next year. So changing tack and coming back a little closer to home, we have Condor, which is 100% owned by Talon. Again, it's Jurassic white gas, and Condor is the largest untested Jurassic white gas structure in the Perth Basin. The comparative difference when we look at watering on a prospective resource level is, up to 5 times more gas and 11 times more condensate. It's a little bit shallower, so it should be cheaper, should be better quality reservoir, access to market. Both the DBNGP and PGP literally run right through the permit. So another exciting prospect. So lastly, our third and final investment highlight, we have a number of near-term value catalysts as we transition into a producer. We're moving from explorer to high margin producer, and right across our Perth Basin portfolio in Mongolia, there's a number of near-term catalysts. And just wrapping up, investment highlights again, imminent cash flow from Wallering, $30 million per annum. A game changer for a company at our current market cap. Exploration upside in Gravantes, which is rapidly developing to service to China's energy market. Condor looks really good. It's another analog Jurassic wet gas in what we've already sort of proven in Wallering, and near-term value catalysts in the next 6 months. I think that, Talon's a very compelling investment proposition, and I'm proud to say that I've purchased enough shares on market to be in the top 40 shareholders. So I have tremendous confidence in where it's going, and look forward to having a chat with you guys later on. Thanks very much.
Thank you very much, Mr. Hauser. Right. I want you to imagine this little idea for a moment in terms of radiation therapy. So imagine a little radioactive particle that you inject into or pop into a tumor, and it kills that off and it doesn't touch anything around it, leaves everything else healthy. Sounds like a great idea, doesn't it? It's actually a reality. And there's a little old company, at the moment they're a little old company, OncoSil Medical, and this fellow up here is a biotech entrepreneur. You've probably seen him before if you've been to one of our conferences. He was here last year with a little application called ResApp, which sold for a cool $200 million. It's been bought out by Pfizer. So he's a pretty happy looking entrepreneur at the moment. And is OncoSil Medical something that we might want to jump on board? Would you please welcome Mr. Leedman, everyone?
So thanks very much. This is a bit of a change of pace because I'm going to talk biotech and not mining. So just to give you something that's, I think, very interesting, and this technology can affect all of us if we're unlucky enough to develop solid cancer tumors. The board and management of this company are very experienced. Nigel Lang is formerly at Certex Medical. Certex is a very famous biotechnology company, was founded at UWA in Perth, and it went on to be sold about 5 years ago for about $1.5 billion. So he's formerly involved with them, and this is a similar sort of field of technology in terms of radiotherapy. Mr. Otto Batula is the company chairman. He was also a director of a company that I co-founded called Imagene Limited, which is now capped at about $1.5 billion. That also came out of Perth. And about myself, I co-founded OncoSil Medical about 8 years ago, also Imagene Limited, and as Chrissy was mentioning, ResApp Health, which I founded in Perth. And that's been I think a 12 times return for shareholders. It just got acquired by Pfizer last month. So that's been a terrific outcome for our shareholders. And I think that OncoSil, now that I've just joined the board, I think that's got tremendous prospects. And particularly, I'm intending to promote this company widely and tell everyone what a great story it is. So in terms of as what the company does, as Chrissy mentioned, it's very targeted. You're taking a radioactive particle and you're inserting it directly into a solid tumor. And it's killing the tumor from the inside out. And this is a very novel way to be able to treat solid tumors. Since the time that the company listed about 8 years ago, it's been through the whole gamut of the clinical trials. It's now received regulatory approval in Europe, and it's also being used in surgeries to treat inoperable pancreatic cancer. Now, that's what it's specifically been approved to do. I'm going to talk about pancreatic cancer in a moment, just to give you a scale of how significant this disease is, but the market opportunity is enormous. There's about 130,000 people that are annually that are eligible to receive this type of treatment in inoperable pancreatic cancer, and the market potential for the product is measured in the very billions of US dollars. I should have said many billions. So in terms of pancreatic cancer, you can see from the list of all the different types of solid tumor cancers that you can, or any types of cancers that you can develop, right down the very bottom is the pancreas. It has the lowest survival rate of any cancer that you could be diagnosed with. And there are obviously very many varied treatments for different types of cancer, but pancreatic cancer is the reason why the life expectancy is so short is because you're typically diagnosed late, and there are very limited therapeutic options for patients. These are the clinical stages of pancreatic cancer. It starts off as a primary It can then spread into the lymph nodes, and from there it becomes metastatic, where it can spread throughout your entire body. Stage 1A and stage 1B are the typical stages where you want to be diagnosed. That's about 21% of people. Most people, 79%, are diagnosed at stage 3 and 4. They've got very, very limited prospects and a very short life expectancy from there. Surgical resection is by far the best way to treat any solid tumor. You're effectively cutting the tumor out. In the case of pancreatic cancer, 15% of cases are resectable because they're diagnosed early. They've got a fairly reasonable life expectancy if the surgery is successful in cutting it out. It becomes locally advanced. This is where it becomes non-surgical. That's the area that OncoSil is focused on, and then metastatic, where it effectively covers the whole body. At that point, your life expectancy is less than 6 months typically. And remember, that's the point of diagnosis. So 55% of people get diagnosed with pancreatic cancer and said, you've got 6 months to live. There's 2 ways of treating it. One is through surgery. Obviously, resection is the best way, and also radiotherapy. There are different types of radiotherapies, but I'm going to describe OncoSil to you. There's also systemic, which you're taking chemotherapy throughout your whole body. This is a sort of a last resort. The people who are diagnosed late do get chemotherapy, but they still only survive for about 6 months. Now, in terms of the OncoSil device, you can see that it's basically a radiotherapy that's injected directly into the tumor. I've got this really cool animation, which I'm about to show you. It runs for about 1.5 minutes, and this will explain to you very succinctly how OncoSil works.
OncoSil is a brachytherapy device that utilizes highly targeted intratumoral placement of phosphorus-32 microparticles to treat locally advanced pancreatic cancer. OncoSil is delivered via ultrasound-guided endoscopy whilst the patient is under sedation or anesthesia. The echo endoscope is slowly inserted down the patient's esophagus through the stomach and duodenum, stopping very close to the pancreatic tumor. A very fine needle is then loaded through the biopsy channel of the echo endoscope and slowly guided through the gastric wall or duodenal wall to directly target the pancreatic tumor. Once the needle is positioned inside the tumor, the exact amount of OncoSil is injected slowly by the physician. The microparticles remain localized in the tumor permanently. Microparticle localization is confirmed by SPECT-CT Bremsstrahlung imaging. The implantation is personalized to the patient to deliver 100 gray of the tumor. With a phosphorus-32 half-life of 14 days, 98% of the radiation dose is delivered to the tumor within 81 days. This very significant dose of radiation causes direct damage to cancer cell DNA, rendering the tumor incapable of cell division and proliferation. Through this mechanism, OncoSil treats the cancer and can ultimately shrink tumor masses. In the PANCO study of OncoSil treatment of patients with locally advanced, non-resectable pancreatic cancer, in combination with chemotherapy, tumors shrunk sufficiently that a quarter of patients in the study underwent surgical resection with 90% long-term survival.
So I hope that animation really gives you a perspective of how novel this therapy is. It was developed by OncoSil Medical, founded in Perth. It's now based in Germany and Sydney. They're actually using this treatment for inoperable pancreatic cancer patients in Europe right now. And this has only just received approval. It's only just being used. So the growth for this company is going to be this treatment, which is quite expensive to be able to use and generate hopefully lots of returns for shareholders. This year is only in the second half of this year is when this procedure really started to take off in Europe. So we've got an experienced team. We've already got CE mark approval in Europe. We've got innovation funding granted in Germany, which is our largest market in Europe. And we're also pursuing other types of cancer, duct cancers coming as well. That PANCO study is the basis for which we received our regulatory approvals. I'll talk about that. And you can see the various regions that we're currently approved in. The FDA is going to be the big one. This therapy becomes available in the United States. That will generate much more significant revenues. And we're optimistic of that coming very soon. So the PANCO study, this is the basis by which we got approval. 90.5% of patients who were treated had controlled disease at 16 weeks. But more importantly, 1 in 3 patients became eligible for resection, which is surgery after receiving OncoSil, and 1 in 4 patients actually underwent the surgical resection with curative intent. That's a medical term that says these patients, according to the doctor, have every prospect of long-term survival following this treatment. And remember, as the pancreatic cancer grows in their body, it effectively becomes spread throughout their body, and then their life expectancy is 6 months, and the death rate is 100%. So the PANCO study shows very clearly we've had 1 in 3 patients receiving OncoSil plus chemotherapy became eligible for surgery. What's effectively happening is the tumor is shrinking. So if you can shrink the tumor, you can actually cut it out. Remember, if you've got a large tumor in your pancreas, unlike say with prostate cancer, you can cut the prostate out, your man can still survive and function normally. But with pancreatic cancer, you cannot cut out the pancreas. So unless you can shrink that tumor and make the patient eligible for resection, their prospects are extremely low. What's most important as well is at the end of the study, we had the follow-up of those patients, and 6 out of the 10 patients that were resected remained alive, 5 without any evidence of disease. Now, those months are actually out of date because those patients are still alive even to this day. So this is the most remarkable outcome for these patients who had absolutely no prospect of survival. This innovative funding in Germany, Germany is really a target market for us. They have provided funding that allows patients in Germany to receive the treatment at a subsidized cost by the hospitals performing that treatment. Of course, that's a full remuneration back to OncoSil, but this has only just occurred. So this is where you can see that the OncoSil treatment is starting to gain momentum as a novel therapy for patients with inoperable pancreatic cancer. And it's also fully funded trial in Germany. Now, the key there is about getting public insurance reimbursement. So if you can actually get on, say, the reimbursements like Medicare, then the cost of the treatment for the patient becomes negligible. And in order to achieve that, we have to do this further trial, which is being fully funded. It doesn't cost the shareholders a dime to do this study. And so that's being done by leading university hospitals throughout Germany. So that is a major new development for the company and really goes to our prospects in terms of revenue growth. And where we intend to go, in terms of our commercial vision, if you look at the milestones that the company has achieved, they're very significant. In terms of getting fully funded government-sponsored clinical trial in Germany, that trial has been done. We had our first commercial sales in Spain. We've also had our first commercial sales in Germany. Most importantly, we've only just announced recently that we're now qualified for private healthcare reimbursement throughout the United Kingdom. So if you've got private medical cover and you're diagnosed with this illness, this becomes an option for you. And this has only just happened. We've got a reimbursement happening in Belgium this quarter, and we have these new trials that we're doing. So in terms of the prospects for the company, I'd really encourage you to look at OncoSil. The share code is OSL. We're well funded. We have a fantastic team. It is a absolutely groundbreaking therapy, and it's something that could be applied to other solid tumors. But importantly, what you need to remember is that this surgery is only just being used in Europe, only following their recent approval. It will generate a lot more media in terms of patients who are using this therapy and having long-term survival, and also in terms of publications in medical research journals. That's very important for usage as well. And then pursuing the FDA goal, which will happen next year. So then we become approved, hopefully in the US. That would be a major catalyst for growth. We're only capped at $50 million. And then really, I think that now that we're in a position where we've got news flow and prospects, I think that was the time for me to join the company that I co-founded 8 years ago and actually get involved and promote what a great story it is. And I'm very proud to be telling you that story today. And my stand will be outside, and I'll be happy to talk with any or all of you. Thank you.
Thank you, Brian, so much. It certainly was a change of pace from all those other ones, and deadly interesting. I wish I'd actually sat and locked the door and made everyone stay in here and listen to it. So thank you.
Thank you.
It's really
very
good,
much.
wasn't it? Really interesting. Oh, did you, a question? Wait, someone has a question. Or are you just stretching? A real question.
When would we be able to envisage something like this being used in Australia? Being
So-
accessible.
The Panko study was actually in part done in Australia with other studies. So in terms of getting TGA approval, that is definitely in the company's horizon. I will just caveat this. In terms of the market opportunity, Australia has only got a population of 25 million people. And so getting TGA approval is a goal, but it's not a strong commercial goal. The big commercial goal is in Europe and the United States, where we can generate very large funds. So that's what we're targeting first. But I very much want to see, now that I'm on the board, to see TGA approval achieved in the next 2 years.
Thanks, Brian. That's amazing. One of my spare little roles, if you need to go to morning tea, feel free. If you want to stay and listen to this interesting human, you can. One of my little spare roles is a celebrant, and 3 of the people that I have held celebrations for life for this year have died of pancreatic cancer, inoperable.
Where is your intellectual property protection? What's to stop me doing the same thing?
Sure. The intellectual property protection is global. So the OncoSil device has been patented in all major markets, including China, for example. It's quite a novel procedure. I don't think it's something that you could just go and copy. Particularly given that you're dealing with a radioactive particle. In fact, if you put that particle into the palm of your hand, it would actually burn a hole right through it. So the key here is that these particles contained within the tumor and they stay within the tumor. So not easy to replicate.
Could you put your hands together for Brian again, everyone?
Thank you.
Right, we're going to take a little break. You'll hear me running around